Crypto regulation in the United States just crossed another important line. After weeks of debate, delays, and political gridlock, lawmakers are no longer waiting for a perfect deal. The Senate Agriculture Committee has officially pushed forward with a new crypto market structure bill, even without bipartisan backing. Chairman John Boozman has released a fresh draft of legislation and confirmed that it is heading straight to markup on Tuesday, January 27th. This bill doesn't try to reinvent the wheel. Instead, it does something the industry has been demanding for years. It treats crypto markets like real financial markets, not legal gray zones. Exchanges, brokers, and custodians are brought under clearer oversight. Rules around custody, transparency, and market integrity are strengthened. And for the first time in the Senate, there is a concrete attempt to define how digital commodities should actually be regulated. The bill is officially titled the Digital Commodity Intermediaries Act, or DCIA. It's a 161-page crypto market structure proposal released by the Senate Agriculture Committee, led by Chairman John Boozman of Arkansas. And crucially, it is moving forward without Democratic sign-off after weeks of stalled negotiations. Markup, the debate, amendment process, and vote, is scheduled for January 27, 2026. At the heart of the bill is a push to clarify who regulates what. The DCIA expands the CFTC's authority over digital commodities while drawing firmer lines around intermediaries, exchanges, brokers, custodians, rather than protocols or users. Some of the biggest unresolved fights remain: how digital commodities are defined, including meme coins, listing standards, ethics rules, and long-term funding for the CFTC. Notably, the bill treats digital commodities similarly to assets like gold or oil, while explicitly exempting frontline developers from being regulated as financial firms. And despite the partisan tension, the crypto industry response has not been hostile. In fact, it's been surprisingly constructive. Coinbase Chief Legal Officer Paul Grewal responded with cautious optimism, posting, "There's still work to be done, but there's a strong foundation here for both Republicans and Democrats to build on. Thank you, Chairman John Boozman, for this constructive step to answer Donald Trump's call to make the U.S. the crypto capital of the world." This tone is very different from Coinbase's immediate rejection of the Clarity Act, which has become entangled in disputes between crypto firms and traditional banks, particularly around yield and custody. The DCIA may offer the industry something tangible to build on if the Clarity Act continues to stall, where crypto stands right now. To understand where things really stand, journalist Eleanor Terrett laid it out in a detailed breakdown. She wrote, "New. Where do we stand on crypto market structure legislation right now?" The Senate AG Committee released its latest legislative text last night, with Chairman John Boozman acknowledging that Republicans and Democrats failed to reach a deal despite an extra 2 weeks of negotiations. She notes that the bill is now effectively a Republican product, with no Democrats on the committee publicly supporting it, including Senator Cory Booker, the lead Democratic negotiator. That sets up a potentially partisan vote next Tuesday, a sharp contrast to the House Agriculture Committee's version of the Clarity Act, which passed with a 47-6 bipartisan vote. However, Terrett adds an important wrinkle. Booker's team told Politico Wednesday evening that he will continue working with Boozman to get the legislation passed and signed into law, so it's possible some Democrats might still vote yes. She also flags a very real wildcard, a major winter storm forecasted for Washington, D.C., which could complicate the markup schedule. But beyond the politics, industry reaction has been largely positive. Reaction has been mostly positive so far, with stakeholders noting the bill's close similarities to the House Agriculture Committee's version of the Clarity Act and praising its protections for non-custodial software developers and infrastructure providers. That distinction, regulating intermediaries, not protocols, is a major reason why this bill is being received differently. DCIA breakdown: what it actually does. One of the most important sections of the DCIA deals with self-custody and DeFi. First, self-custody wallets are explicitly not regulated. The bill limits CFTC authority to digital commodity intermediaries, entities that take custody, execute trades, hold collateral, or act as agents or counterparties. A wallet that simply stores private keys, signs transactions locally, and broadcasts user-approved transactions does not meet that definition. The practical effect is clear: no registration, no KYC or AML, No reporting requirements, no supervision. Self-custody is treated as a user activity, not a regulated service. Second, non-custodial DeFi interfaces are generally protected. If an interface does not take custody, does not control execution, and cannot override or prioritize transactions, it is not regulated under the Act. That includes DEX front ends, aggregators, wallet-based swap interfaces, non-custodial bridges, protocol dashboards. The bill explicitly denies the CFTC authority to regulate mere software publishers. However, the line is firm. If an interface takes custody, executes trades on behalf of users, controls routing logic, or acts as a counterparty, it becomes a regulated intermediary, regardless of whether it calls itself DeFi. As the framework makes clear, decentralization in name does not matter. Control does. The takeaway is simple. If you don't touch the money and you don't control the trade, you're not regulated. Why this matters? The Digital Commodity Intermediaries Act is not the final answer to crypto regulation in the US, but it is a signal. Lawmakers are moving forward, even without consensus. The industry is engaging rather than rejecting. And for the first time in the Senate, there is real legislative momentum around market structure. At the same time, the Clarity Act remains delayed, tangled in negotiations between Coinbase, the banks, and Senate banking, with no markup expected until at least March. That raises a critical question. If the DCIA advances first, does it become the foundation the rest of crypto regulation is built on, or does it increase pressure on banking to resolve the yield debate and move Clarity forward? Either way, the next few weeks matter. Tuesday's markup could set the tone for the entire year. As Washington debates its next move, the rest of the world is already shifting into execution mode. According to PwC's latest Global Crypto Regulation Report, 2026 is the year crypto regulation becomes a global reality, not in draft form, but in live enforceable rules. PwC says crypto regulation is becoming more defined as legislation progresses from proposal to law across major jurisdictions. And the countries with the clearest, most transparent frameworks are expected to lead the next phase of the industry. What's changing is the tone. PwC notes that the environment ahead will be defined less by regulatory debate and more by execution, with jurisdictions increasingly competing to attract capital, credibility, and long-term legitimacy. There's also a noticeable acceleration in cross-border coordination aimed at improving market integrity, combating financial crime, and strengthening investor protection. Matt Blumenfeld, PwC's global and U.S. head of digital assets, put it bluntly, regulation is no longer a constraint, it's actively reshaping markets and enabling digital assets to become the architecture that allows them to scale responsibly. For crypto firms, this shift cuts both ways. Compliance costs are rising, but clarity is rising with them. And that clarity is what unlocks banking access, institutional participation, and more sophisticated products. And right now, these issues matter more to the crypto industry than at almost any other point in its history. The cryptocurrency market finds itself at a deeply uncertain and confusing crossroads. On one hand, concerns around persistent price manipulation and market suppression are growing louder by the day. On the other hand, this is the moment the industry has spent more than a decade fighting to reach, the moment when major institutions and even sovereign wealth funds are seriously looking to step in. We are finally on that global stage, and instead of calm, the stakes have only intensified. Crypto now has to prove that it truly deserves its place there, and one of the clearest, strongest ways to do that is through well-defined, credible, and properly enforced regulation. 2025 was deeply disappointing for many investors who expected the post-halving year to deliver explosive upside. Instead, momentum stalled, narratives faded, and patience wore thin. If we're being honest, 2026 doesn't yet look dramatically different. Unless something extraordinary intervenes, meaningful legislation, aggressive liquidity expansion, or a clear policy green light, the market risks drifting rather than breaking out. That's why moments like this matter. As of 7:20 a.m. Eastern on Friday, price action across major crypto assets remains constructive, but far from euphoric. Bitcoin is holding just under $90,000, up nearly 7% on the week, continuing to act as the market's anchor. Ethereum is outperforming, up more than 11% over 7 days, trading just below $3,000 as investors continue to position around scaling, ETFs, and institutional use cases. Solana is also up double digits on the week, reflecting renewed interest in high-throughput networks. XRP, BNB, Cardano, Tron, and Dogecoin are all higher on a weekly basis, but none are showing the kind of runaway momentum that defines a full speculative phase. This is a market that's waiting, not panicking, not euphoric, but watching policy signals very closely. Despite the uncertainty, there are real catalysts on the calendar. Next Tuesday, the SEC and CFTC will hold a joint event to discuss regulatory coordination and their efforts to deliver on President Trump's promise to make the United States the crypto capital of the world. SEC Chair Paul Atkins previewed the event, writing, "I'm looking forward to joining Mike Seelig next week at our SEC and CFTC joint event to discuss harmonization between our two agencies. Together, we will discuss our efforts to deliver on President Trump's promise to make the U.S. the crypto capital of the world. Join us." That kind of language, harmonization, coordination, shared goals, would have been unthinkable just a few years ago. President Trump recently said as much during his speech at Davos 2026.
I'm also working to ensure America remains the crypto capital of the world. And to that end, last year I signed the landmark Genius Act into law. Now Congress is working very hard on crypto market structure legislation, Bitcoin, all of them, which I hope to sign very soon, unlocking new pathways for Americans to reach financial freedom.
When you step back, the picture becomes clearer. Globally, regulation is no longer coming. It's arriving. In the U.S., lawmakers are moving from stalemate to structure, even if the path forward is still uneven. For markets, this isn't about hype, it's about foundations. If you're a smaller investor, this phase can feel frustrating, slow, noisy, and uncertain. But historically, these are the moments where positioning matters more than emotion. You don't need to predict every move, you just need to understand the direction. If you value clear, calm coverage of what actually matters in crypto, consider subscribing, leave a like, and share your thoughts below. We're tracking this closely. Thanks for watching, and see you in the next one.